gentlemen, good day and welcome to the Oriental Limited Q2 and H1 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. We have with us today on the call from the management of Oriental Limited, Mr. Aditya Gupta, Chief Executive Officer, and Mr. Himanshu Jindal, Chief Financial Officer, along with Stellar IR Advisors, Investor Relations. The management will be sharing key updates and financial highlights for the quarter ended September 30th, 2023, which will be followed by a question and answer session. Please note that some of the statements made in today's discussion may be forward-looking in nature and may involve risks and uncertainties. Oriental Limited will not in any way be responsible for any actions taken based on such statements and undertake no obligations to publicly update these forward-looking statements. Documents relating to the company's financial performance are available on the website of the stock exchanges and the company's investors section. Trust you have been able to go through the same. I now hand the conference over to Mr. Aditya Gupta for his opening remarks. Thank you, and over to you, sir.
Thank you. Good afternoon, ladies and gentlemen. Welcome to the Q2 FY24 earnings call. It has been a tough quarter for us, with the marketplace demanding liberal credit and lower prices. We dropped our prices in some categories by 8-10% during Q2, and this reflected in an ASP drop of Rs 16, which was partially made up by an improved product mix, that is more GVT and vitrified. As the price cuts took time to play out, our revenues continued to be under stress with a 7.4% drop in the quarter, while volumes were slightly better at 3.8% drop year-on-year. Some of the major highlights of the quarter are: a new GVT line at Dora has started commercial production. This has added 3.3 million square meters to our capacity. The project has been completed ahead of schedule and at a significantly lower cost than planned. The ramp-up of sales teams with our teeth-to-tail ratio further improving to 2.35, which is the highest ever. Branding investments have been maintained in spite of a tough quarter. On the product profile side, GVT is now almost a quarter of our business, up 2.2% year-on-year. Similarly, vitrified, which includes GVT, vitrified salience is growing strongly and now stands at 47.6%, which is up 5% year-on-year. During the quarter, we also launched 150 plus new SKUs across our units. We continue our focus on strengthening the business basics, and as Morbi gas prices have started hardening and our price drops are working through the markets, we expect a recovery going forward. Thank you.
Thanks, Aditya. Good afternoon all. So last few quarters have not been great from a revenue point of view for OBL, impacting profitability. Markets have been sluggish, and the aggression from players did intensify, not only on pricing but also on credits in Q2. Something that we have avoided as we believe in more sales backed by actual cash flows, especially when the uptake is slow. Our trading operations have done well. Growth in volumes was more than 17% on a YOY basis, and our trading margins expanded as well, backed by the improved product mix, despite the drop in realizations. On the other hand, volume from our own manufacturing were down 11.5% YOY, and this was the primary reason for the lower top line in Q2. On the cost front, fuel and the other input costs have come off, which is helping in the sustenance of gross margins sequentially, despite a drop in the ASP by 3.5%. From a year-on-year perspective, last year with costs rising almost every quarter, we ended up selling stocks from cheaper inventories, opening inventories, which was not the case this time with the drop in overall cost of production. So this inventory change is one reason why our blended gross margins, at least in this quarter, are still lower by 3% on a YOY basis versus quarter 2. The other reason for the drop in blended gross margins was obviously the increase in trading mix by 6% versus last year. The fixed costs and other costs, which is depreciation and finance charges, were largely similar to last year. Balance sheet remains resilient with overall debt and liabilities and our core working capital continues to be roughly 25 days for now. CRISIL reaffirming our credit rating also reflects the same. On the capex front, we were able to commence commercial production from the new line, the new GVT line at Dora, well within time, and our actual spends, like Aditya mentioned, were lower than what we planned for. Thanks to the good savings coming in from the overall lower cost of imports and better than planned execution of the project. The detailed presentation is already available on the exchanges, and we'll be happy to answer if you have any questions now. Request the moderator to please open the line for Q&A.
Sure. Thank you, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rohit from Samatva Investments. Please go ahead.
Yeah. Hi, good afternoon, sir, and thank you for the opportunity. So my first question would be if you could highlight broadly geography-wise, so north, south, and western market, the demand scenario, and how do you expect it going forward during the second half of the year?
Hi, afternoon, Rohit. I think demand has been broadly similar across geographies. There is not much of a difference. So, and not much data also available per se, but one thing which is clear is that the demand for exports has been very robust in quarter 2. We estimate about 40 to 45% growth on exports in quarter 2 over last year's quarter 2. But domestic has been similar.
Got it. So my basic reason for asking this question was because we have recently started the Dora facility, and if there is sluggish demand currently right now, so how soon do you expect the Dora facility to ramp up, in terms of capacity utilization? Or do we have to take a major price cut, to enter into the South India market, because this is comparatively a newer market for the company? Just wanted to know, to get your views on how do we plan to actually increase our market share in the southern market, given that the demand is actually a bit sluggish overall right now.
So, Rohit, I think I agree with you. South is an extremely large market especially for GVT, and it's a market where we have not had any significant play. We have been more north and east focused. So the Dora product the new line is something which is focused on south and west. And as Himanshu was saying, with the project actually coming in at a significantly cheaper capex than what we had envisaged. To give you a figure, it was about 18-19% cheaper than what we had thought of. We have a strong capability to compete from Dora. Another thing which you might not be knowing is that we have the advantage of APM gas in Dora, which we are paying about 26 odd rupees per cubic meter. So from that perspective also, we are from a cost perspective, we are very strongly positioned to kind of meet competition head on ex-Dora. So we are quite hopeful that the ramp up of Dora GVT line will be very good.
Got it, great. So just a follow-up was that in terms of back-end, in terms of distributor reach, in terms of marketing, how much have we progressed or how much is still left to do in South India? Because since it's a new market, I want to know in terms of distributors, how do we plan to expand? What is our current share of South India distributors? And apart from that, in terms of back-end, like how ready we are to be in the South India market?
So when you talk of share, unfortunately in the industry, we don't have any GfK type or Nielsen type figures which are available, which would actually give any authoritative breakup on the kind of KPIs you have talked about. So let me answer it in a broader thing. See, we have been present in South. We have a large network of Bell Ceramics, but we are doing largely ceramics there, not GVT. So in terms of having a trade familiarity with Orient Bell, in terms of existing trade relationships with Orient Bell, they are already there. But our share of the distributors' overall business was much smaller because we are lacking this critical GVT product. With this now coming in, I think we can ramp it up significantly. We have been building up our teams in South for the last 6 months. Today, in the opening statement, I talked about how our feet to tail ratio, which is the number of salespeople to non-revenue generating employees, has further improved to 2.35. And a large part of the increase has actually come in from Southern India. So that is the second initiative which is in place. We have since September, actually the third, fourth week of September, we have been on a massive distribution outreach program, which would have, so our mobile displays have visited some 100-odd towns in South India, South and West, largely South India, over the last 2 months. So a lot of activity is happening there, so that the product from the Dora plant is kind of well received and is distributed across South.
Got it. So out of the Orient Bell boutiques right now, how much would be in South India, if you could, if there's a number you could share?
So Rohit, we have 355 or 356 boutiques. We have been churning out a lot of non-performing boutiques this year. I don't have the numbers offline available. Maybe Pooja, you guys can just note it down. We can then share it with Rohit offline.
Got it. Great, sir. Thank you. So just one last question. So in a recent interview, the market leader said that because the Morbi guys are focusing a lot on the export market, there's a potential and the organized players are actually gaining market share in the domestic market. So would that also be a true statement from Orient Bell's perspective? Are we seeing some improvement in terms of, I get it, volumes may be a bit lower, but is Orient Bell actually gaining some market share to the Morbi guys in our strong areas?
Hi, Rohit, this is Himanshu. You see, there are roughly 800 odd plants, operating out of Morbi today. Yeah, when we talk about tiles. So whatever results you see is obviously 3, 4, 5 players in total. There are 795 more that you may not be tracking actively. Yeah. So yes, you are right. There have been structural reforms over the last few years where things have changed. Right. It's becoming difficult for Morbi guys to penetrate domestic markets because earlier what they were doing largely throwing pricing by being non-compliant. That is out of the game. Especially post-COVID, I think again very clear. They understand that we can do better in terms of selling ourselves as branded players onshore, and they can do better selling offshore as exports. This is something which is more or less established. So yes, you are right in a way that yes, today, like Aditya mentioned, the demand conditions have not been so ripe, especially in the last few quarters. And therefore, given the pricing and the credit scenarios panning everywhere, based on how someone wants to play. He may have gone in for market grab shares, etc. So yes, just to answer you in a net way, market share gains by branded over unbranded is happening, which is clear. How things would have panned out over a quarter-to-quarter basis, we need to see.
Got it. Good. So that's it from my side. And just one last thing, I hope Mr. Daga is doing fine health-wise. So please, good wishes from my end, and wishing the entire Oriental team warm regards for the upcoming festive season. Thank you so much.
Thank you, Rohit.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1. The next question is from the line of Gunit Singh from Counter Cyclical PMS. Please go ahead.
Hi, sir. Thank you for this opportunity. So, sir, one of our largest competitors, one of the biggest players in India, Kajaria, they recently reported their results, and we saw an year-on-year growth in revenues as well as margins for them. While for us, it is quite the reverse. So, I mean, what are we doing different that we are not able to achieve, growth year on year? And what can we do different, in your opinion, to, get back to the growth trajectory?
Okay, thank you, Gunit. See, our margins are extremely sensitive to top line, and I think you're talking about the market leader. They had talked about how their overall fuel cost has come down quite a lot because they have started using some biofuels and all, which is something which we had started doing almost 2 years back. So our last year baseline already had captured that benefit. The bigger part, I think, is the revenue piece, the top line piece. And this is where, for a company of our size, every extra kick in revenue adds very disproportionately to our margin. More so because in our own manufacturing this thing, we enjoy healthy margins. What we have not done well, specifically coming to you, what we want to do well, I already spoke to Rohit about that. So South is a major area of focus. We have seen how the market is moving very rapidly into GVT, into vitrified, and this is one area where historically we have been much more of a ceramic play. A couple of years back, we were almost 2/3 of our business was of ceramics. Now it is kind of down broadly to about 50-50. And this is something which we have to catch up, and for us, the loss on the ceramic business is kind of dragging us down. With this Dora line coming in, we expect that the overall growth in our vitrified business will more than compensate for the loss due to the changing preferences of consumers.
All right. So in H2, looking at the current demand scenario and with the addition of our new line, what kind of growth, are we looking at any growth in H2? And what kind of additional revenues should we expect from a new line, and how do we expect it to ramp it up in the coming quarters?
So we don't give out a forward-looking revenue guidances. Definitely when we have put up this line in Dora, there is a clear plan to address the market with that. It's serious capacity, 3.2 million square meter capacity, which is now available to us, annual capacity, which is now available to us from September. And as I said earlier, there is a robust plan to build up distribution, to build up our team's distribution. And we also share that the company is now working on a big marketing campaign, which is something which now that we have got the teams and the product in place, we would shortly be coming out with a large marketing campaign which would basically drive this brand preference and help us sell this incremental capacity.
All right. So would the marketing campaign, put some more pressure on our margins, which are already at quite a low level? And in terms of the guidance, since the fuel prices have also gone down, like you mentioned, do we expect margins to get to, better levels, even FY23 levels? Do we expect that for H2?
So, Himanshu this side again. Aditya mentioned we have to do branding. This is something which has been agreed with all stakeholders internally. And yes, it may have repercussions on the short-term profitability. This is understood. But please do appreciate there's a lot of capex already gone in. I have to make sure that we sell volumes. I think one learning that we had over the last 1.5 years is that, earlier, whatever branding interjections we did, these were largely digital, which is what helped us sell more when the markets resumed with a vigor post-COVID. Yeah, we were already doing virtual showrooms, etc. This also helped. Today, last 1.5 years, what we've realized, largely whatever we were doing is already copy-pasted by our peers, and they eventually started spending more on mass media, something that we were not doing because of the deep pockets that we don't have. So there is a consensus now that yes, what we need to do on volumes, even if it comes at a cost to the short-term profitability, that should be okay. Part of this will obviously come in from the volume ramp-up, in terms of the margins. And the balance would obviously come in from some product mix as well, gains as well, right? So we have to go for it. In terms of the gross profit margins, you would have seen how we have done over the last few quarters, over the last few years. By 21-22, for example, or 22-23, we were in line with the best, or we were the best. You count any listed, unlisted, all put together, I think we were clearly there. Last few quarters have been difficult for reasons that we spelled out, largely revenues, largely the gas price differentials that we had versus the others. I think with some of these elements getting addressed now, I think over a period of time, our gross profit margins would again be more or less in line with the best. And then when the scale kicks in, automatically a lot gets addressed. Yeah? Does that answer your question?
Yes, it does. So, what kind of ad spend do we anticipate for H2 or going forward as a percentage of our revenues?
We are still looking at it. We are trying to see what makes sense. We have to make it meaningful. This is clear. And, whatever we do has to be more consistent, at least for some quarters. Yeah, some years. So we have to be very cautious as to what we do. This is still in the making. Allow us some time, and then we can, obviously come back.
All right. Got it. And what's the current capacity utilization?
These were not great. Already our sales. It's there in the detailed presentation. So, it was largely in line with what we sold, the production. And therefore, the capacity utilizations on a blended basis have not been that kind. Please do remember there are new capacities which come up last year, and the market conditions have been sluggish. So count all of that in. It's something close to 70%, just to answer you. For quarter 2, we were operating at something like 70% off.
All right. That's all from my side. Thank you. I wish you all the best.
Thank you.
Thank you. Participants who wish to ask questions may please press star and 1. The next question is from the line of Keshav Garg from Counter Cyclical PMS. Please go ahead.
Sir, my concern is that this is the 4th consecutive quarter when our sales are dropping year on year. Sir, and if we compare our numbers with the industry leader, then they have shown mid-single digit growth year on year. So today Prism Johnson also came out with their numbers. They have also shown year on year growth in their tile segment of mid-single digit, and their PBIT has tripled. Kajaria's PBIT has also gone up 40%, whereas it is understandable since our top line is only falling and we are losing market share, then obviously operating deleverage will kick in. So the primary concern is that when will we stop losing market share from the already low base that we are in?
So I think valid this thing. As I talked about some of the reasons that we have in terms of we have had in terms of a very high ceramic play. I think with the new capacities which are coming up, we only had between our vitrified capacity has historically GUT capacity has been very low. With this new line coming in, for the first time we can seriously address some of the biggest markets in the country, which is South and West. So I think going forward with the teams in place, with the new ad campaigns which we are talking about, which you said is going to be a very significant departure from what we have done in the past. And also the new product, which is a GVT line, we expect that things will get better.
So now that we already have a low base for the second half of this year, that even last year in the third quarter, year on year, our revenues fell. So you think that now going forward in the second half of this year, at least on a year-on-year degrowth, this trend will get arrested and maybe reversed, or maybe if not reversed, first the trend has to stop of year-on-year fall in revenues. So in your judgment, by when can we expect that to happen?
So I think again you're asking me a guidance kind of a thing. I have already answered that. You're just kind of asking the same thing in slightly different words. We have said that.
I mean, it's a pretty simple question that
I understand your question very clearly. It is a simple question, yes. But I also said that as a policy, we don't give out forward guidances. So that's also a very simple
statement. Because you see, the tile market is not shrinking. So there is something that there is some problem that when the market is not shrinking, then why are our revenues shrinking?
Keshav, let me try and pitch in here. See, please try and appreciate, and I'll take you some time back when we were doing very well. Yeah, why were we doing so well in 2020, 21, 22? Yeah, I think a lot of our initiatives played out then. Yes, the base was smaller, and we were doing very well. Right? The markets were resonant, and we were doing better than our competition. Why were the markets so better? Because there was a whole lot of rejuvenation demand or a renovation demand or expansions happening at homes. There was unsold inventory that the developers were selling as well, where the last mile finishing was still to be done. This is where the tiles demand was essentially coming in from. Last 1.5 years have been difficult. Not only you would have looked at our commentaries, I'm sure you're quoting the market leader. Market leader also may have said that the markets have been challenging. Even the guidances that they might have given may not have been, the actuals may have been different than that. Right? So it's not something which is so unknown. Everyone is saying the same thing. Yes, the market leader and few others who have put in a lot of money and effort in terms of building the brand earlier, in terms of putting up more and more GVT capacities earlier, they have been able to show growth, which is understandable. They have gained market shares. But like I said, there are 800 players. If you exclude all those who are doing exports and you exclude all those who are in those top 3, 4, 5 rankings, you would find the majority who are selling onshore are finding it difficult to sell. And this is where, Aditya and me, we both mentioned, branding investments is something that is agreed. Mass media campaign is something that we are coming out with. There is a new Dora GVT line which is going to support the scale up, especially for South, which is a market where we were not present at all. Our vitrified mixes there in that market was horrible, right? So we were not selling enough GVT. All of that should happen. Now, how soon? We are very hopeful that the markets are going to revive very soon as well. That's our belief. Again, based on a very simple fundamental that last 1.5 years have been tight, but there are still launches happening. There is still a lot of construction material, building material, which is getting sold in these year, and you see that in all numbers which are coming in from other building products, right? So eventually, as and when the finishing happens for these apartments, condominiums, real estate deliveries, whenever they happen, they have no choice but to go to players who can service that demand. Would they go to unbranded or would they go to branded is the question that you need to answer and I need to answer for ourselves, right? So I think as and when the market conditions ripen up with all these investments which are going in, we should be able to come back strongly. So just allow us some more time, be more patient.
Sure, sir. Sir, and also till last quarter, you mentioned that we were at a disadvantage as regards the gas cost.
Yes.
So where do we stand on that parameter today?
We are very much now more or less in line with whatever is happening everywhere. I think in Hoskote we still have a disadvantage, but largely all across we are very strong. So in Secunderabad, if I count my blessings in terms of what I fire in my spray dryer, the biofuels, etc., plus the gas put together, my blended cost is around 39-40 rupees, which is very close to where the others are operating in that market. Even in West, in my own plant, Aditya mentioned, 27 rupees per FCM is what I pay in the new line in Dora. Whatever my associate entities, my JV partners produce in Morbi, that's exactly in line with what Morbi produces. So Dora is slightly at a disadvantage, but generally if you see, we are largely now in line with the market. But please do remember that gas prices have gone up a little in the month of October by 2.5, 3, 4 rupees roughly across locations.
Sure, sir. Sir, thank you very much, and I sincerely hope that we stop losing market share at the earliest, and sir, best of luck.
Thank you, Keshav.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1. Participants who wish to ask questions may please press star and 1 at this time. We have no further questions. I would now like to hand the conference over to Mr. Aditya Gupta for closing comments. Over to you, sir.
Thank you. Thanks everybody for your participation. Look forward to getting back to you in the month of January. Thank you.
Thank you.
Thank you. On behalf of Orient Bell Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.